You might be surprised to hear this, but according to a recent 2024 survey, nearly 40% of Americans who have life insurance actually have no idea what type they own. Even more surprising, over half of them say they think they have the right coverage, but when asked about the details, they couldn't explain it. That's not just a small oversight. That's a potential financial disaster waiting to happen. But fortunately today, we're going to fix that. Because in this video, I'm going to walk you through term insurance. What it is, how it works, who it's for, and how to know if it's the right choice for you. So, grab a coffee, take a deep breath, and let's make this simple. Part 1. What is term insurance? All right, let's start with the basics. Term insurance is exactly what it sounds like. It's life insurance that lasts for a set term. That could be 10 years, 20 years, 30 years, sometimes even more. If you pass away during that time, the insurance company pays your beneficiaries a lump sum of money called the death benefit. And if you outlive the term, the policy ends, and there's no payout. It's really that simple. Now, here's where it gets interesting. Term insurance is usually the most affordable way to get a high amount of coverage. That's why it's often the go-to option for young families, people with mortgages, or anyone who wants a lot of protection without paying massive monthly premiums. Part 2. Why is it cheaper? So, why is term insurance generally cheaper than other types, like whole life? Here's the key reason. Term insurance is pure insurance. You're paying for protection, not for investment growth, not for cash value, not for anything fancy. With whole life insurance, for example, part of your premium goes into a savings component that builds over time. That's why it's more expensive. But with term, every dollar you pay goes toward covering the risk during the term you choose. And because many people outlive their term, the insurance company doesn't always have to pay out. That lower risk for the insurer shop means a lower cost for you. Part 3, how does it work? Let's walk through a quick example so you can see this in action. Imagine you're 30 years old. You buy a 20-year term policy for $500,000 in coverage. Your monthly premium might be, let's say, around $25 to $40, depending on your health and other factors. If you pass away at any point during those 20 years, your beneficiaries get that $500,000 tax-free. If you're still alive when the 20 years are up, the policy simply expires. No payout and no more premiums. You can think of it like renting protection for a specific amount of time. Part 4. How long should your term be? Choosing the right term length is huge. A lot of people make the mistake of just picking a number without really thinking it through. The length you choose should match the timeline of your biggest financial responsibilities. If your main concern is your mortgage, you might match the term to the years left on your loan. If you have young kids, you might want a term that lasts until they're financially independent. Here are quick examples that can influence a choice. A 10-year term because you're close to paying off major debts, or your kids are almost done with school. A 20-year term because you're in your 30s or 40s and you have young kids or a new mortgage. A 30-year term because you're locking in coverage for a long time while you're younger and want to protect your family for decades. Remember, the longer the term, the higher the premium, but the more years you're protected without worrying about renewing. Part 5. How much coverage do you need? This is the next big question, and here's the truth. Most people underestimate how much life insurance they really need. A common rule of thumb is 10 to 15 times your annual income. So if you earn $60,000 a year, you might look at a policy worth $600,000 to $900,000. But don't just stop at income replacement. Think about your mortgage balance, debts like car loans or credit cards, future college costs for your kids, or everyday living expenses for your family. If you want a quick formula, add up all those expenses and debts, subtract any savings or existing life insurance, and the result is a good starting point. Part 6, the application process. If you're thinking, okay, this sounds good, but how hard is it to get? Good news, it's usually straightforward. Here's what typically happens. You apply, either online, through an agent, or over the phone. You answer health questions, things like your medical history, height, weight, and lifestyle habits. At the end, a medical exam may be required, though some insurers now offer no exam policies if you qualify. Then they review your application, also called underwriting. Finally, they give you an offer with your premium amount. Once you accept and make your first payment, you're covered. And here's a tip. The younger and healthier you are when you apply, the lower your premiums will be. So probably don't wait until later if you already know you need it. Part 7. The pros of term insurance. Let's hit the highlights. 1. It has affordable premiums. You can get a large amount of coverage for relatively little money. 2. It's quite simple to understand. It has no complex investment components. You just pay a premium and get a coverage amount. 3. It's flexibility. You simply choose the term length and coverage amount that fits your needs. For many people, those 3 points alone are enough to make term the obvious choice. Part 8. The cons of term insurance. As you can imagine, no product is perfect. Here are some of the drawbacks. 1. It expires. If you outlive your term, you get no payout. 2. Renewal can be expensive. If you need coverage after your term ends, it may cost much more because you're older. 3. No cash value. There's no savings or investment growth, so it's purely protection. That's why it's important to line up your term with your actual financial needs, so you're covered during the years that matters most. Part 9. Who should get term insurance? Usually, if you have people who rely on your income, a spouse, kids, aging parents, you probably need life insurance. And for most people, term is the most cost-effective way to get it. It's especially good for young families who need high coverage at a low cost, people with a mortgage or large debts, or business owners who want to protect their partners or employees if something happens to them. Part 10. Common mistakes to avoid. Now, before you run out and buy a policy, here are a few traps to avoid. 1. Waiting too long. Every year you wait, your premiums go up. 2. Getting too little coverage, meaning not covering yourself enough, especially if you have the cash flow. 3. Not comparing quotes. Rates can vary a lot between insurers, but pay attention to the rules and benefits each offers. 4. Forgetting to name beneficiaries, or not updating them when life changes. At the end of the day, term insurance is about peace of mind. It's knowing that if the unthinkable happened tomorrow, your family wouldn't have to worry about how they're going to keep the lights on, pay the mortgage, or send the kids to college. It's less about you, but more about them. And for most people, term life insurance is the simplest, most affordable way to make that happen. So, now you know the basics. You know what term insurance is, how it works, who it's for, and how to choose the right policy for you. If you found this helpful, hit that like button so more people can get the clarity they need. And if you want to compare this with whole life insurance or a less-known insurance called variable life insurance, you can click here or watch the full insurance content list we have on the channel. Until then, take care of yourself, my friends. Goodbye.